Hey everybody, welcome to the Landcat Studios. I'm very pleased to be joined by this guy who is Alex Kovach from Nucleus. How are you doing, Alex?
I'm very good, Mark. Thank you for having me. It's always fun to come down to your offices.
Alex is not enjoying being filmed, everybody, but he's going to do it anyway, and he can't escape because it's quite a small room, and just behind the cameras there is Mark Locke that's stopping him leaving.
Indeed.
All right, so we're going to talk a little bit about the business, we're going to talk about what Nucleus is up to and all that stuff, and I've got some industry issues I want to ask you about as well.
Okay.
Nothing's off limits, and I hope you'll enjoy the chat. So easy ones first, right? Tell us about how Nucleus is doing. You've had your results fairly recently and all that stuff. So tell us about the business and the shape it's in.
Yeah. Well, look, the results are really just an indication of how we're doing, and I think we are doing what we said we were going to do. We're building a business for advisors, and we're building a business that's about retirement, making retirement more rewarding for advisors' customers. So it's very much about the outcomes that we deliver, and we're doing that through buying other businesses. So we bought Nucleus last year. That's gone very well, and it's driving scale and it's driving profit, and that's enabling us to invest in price, product, and service. And we will continue to do that. And we've got Curtis Banks, where we are, in the middle of an acquisition there, and that should help us, get to the next level and continue to do that investment.
So I think it's interesting for advisors to watch this business, right? Because everybody knows the constituent elements of it with James Hay and Nucleus, and now I'm guessing Curtis is going through all the regulatory kind of hoo-ha that it has to go through, and it will be ready when it's ready. But so we'll think about the first two, and is the strategy about just buying more and more platforms and adding more and more as time goes on? Are you looking for firms to place kind of ongoing new business with you? Are you a consolidator now? What's the kind of overriding strategic kind of direction for the group?
Right. So our overriding direction is to make retirement more rewarding for advisors' customers. That's our purpose, and we're doing that exclusively through advisors. So we work exclusively with advisors. We believe that the way we can make that happen is by having scale in the market. So we're buying other platforms to get that scale.
Yeah.
We're able to translate that scale into profit, and we're using that profit to reduce the price. We reduced the price last year on the Nucleus platform. We're hoping to do that again this year. We're improving service. We're investing in product, and we'll continue to do that so that the advisor experience improves over time. But we want to be a suitable place for advisors to put new monies. That's ultimately what we're about.
All right. So it's kind of riding both horses then.
Yeah.
And obviously, as you've been going through this process of acquisitions and stuff, there's instability in that for firms, right? And firms naturally react to that I guess based on historical kind of data, where things have always been quite challenging. We know, kind of cut into the chase here, we know that eventually there's a unified home for the group, which is going to be on FNZ technology. But at the moment, if you're a Nucleus advisor, you're on the Nucleus platform, as we've all known it for many years, which is on a different technology from Bravura. What's the story there? Are we expecting to see you stay there for a while? Is a move to FNZ imminent for the Nucleus assets? What can you tell us? And I'll bear in mind that there's only going to be so much that any corporate officer can actually say.
All right, well, I think the first thing is we're building a sustainable long-term business. So, actually the fact that we're creating profitability and we're investing in the business is all part of that long-term sustainable direction that we're heading in. I think the second thing to say is that we are working with FNZ. We're building a platform with FNZ. We're not rushing it. We will launch it when we are ready. We hope to launch it this year, but we're not rushing it. We have then a lot of work to do with the James Hay audience to migrate the James Hay audience.
Right.
And so I think the Nucleus customers on Bravura will be on Bravura for quite some time, and we're very conscious of that, and we're very conscious that we want that to be a great experience and a suitable place create good outcomes for customers. And so we're continuing to invest in the Bravura platform, and we will be continuing to invest over the next few years.
That's quite an important thing for people to hear, I think, because everybody loves a bit of gossip, right? And there's all kinds of stuff going on about what order will things go in. So that's some really really good clarity. I mean, we could be looking at some years here.
This is a multi-year ambition.
Yeah.
We're planning for the future. This is about building a sustainable business.
Okay, so if I'm an advisor that's a Nucleus user, whether it's historic or current, what do I need to know? I need to know that the technology, as it stands at the moment, the platform that I'm used to, I'm going to be with for the foreseeable, right?
I think it is the foreseeable, and I think we can assure those customers that we're going to be investing in Bravura and making sure that creates good outcomes and it's a good experience for them. I think the other point I would make is our industry is going through a lot of change.
Mm-hmm.
I think we're trying to build a scale player that will be a leader in this market into the future. I think there's an awful lot of change going on elsewhere. I think that there's not going to be many places in this industry where there isn't going to be quite disruptive change and re-platforming going on. So I think with our scale, we can ensure that we do this in the right way and we do this in a quality way, and that's certainly our intention.
So I'm glad you kind of brought up the disruption stuff, because this feels like it's quite an exciting time. Platforms been a little bit whisper it dull for a while, and they're much less dull at the moment, which is awesome, especially if you do what we do for a living, which is write about platforms and all that kind of stuff. So it's working great for us, which is obviously the main thing. But we do have lots of new entrants turning up. We've got new models there, and of course many of them are relatively early in their journey and are saying things that are quite different. So saying, well, scale isn't necessarily the game, and this is a discourse that's come in and out over the years. But you seem really set that having serious assets under your belt is essential to be successful in the future. You can't be a small kind of niche player and make it work.
Yeah, no, I absolutely believe that scale is critical for success in this market. But just back on one of the things you said, I always think that for us to be successful, we need to be boringly reliable. That's kind of what a platform is about. It's about being boringly reliable, and it's about being behind the advisor and making the advisor look good. That's our job. We're not the exciting part of the industry. We're about delivering reliably. But you're right, it's quite interesting what's happening in the market right now. And we do have new entrants and we do have new models coming in. And I think it's really worth stepping back and thinking about those models. I think scale is paramount, and I think that there are going to be instances where advisor as a platform may make sense. I think when the advisor consolidators really get to scale, and in my mind, scale is 40 to 50 billion. There won't be many advisor consolidators that get to that scale, but I think if you get to scale, it does make sense to start considering taking on the responsibilities and the cost base of running a platform. I think that's right. But I think for the majority of advisors and actually the majority of consolidators, it's going to be difficult to really make that work. Mm-hmm. And I think what matters is, for us, we're going to be a leader. We need to be meeting advisors' needs. We need to be really understanding what they're trying to achieve. And I think what's really interesting is, what are the consolidators and the advisors trying to achieve with the advisor as a platform model? Mm-hmm. And we think there are a number of things. We think it's about control, it's about branding, it's about sometimes it's the private equity pressure around EBITDA. We believe that we can solve a number of these issues and needs that the advisors have. And we think we can be flexible enough and we're big enough to be able to get into conversations with these advisor firms and solve their problems in different ways than the classic advisor as a platform, which may actually be a lot easier for them in the longer term. So I think it's exciting. I think there are opportunities for us.
Yeah. Okay, really interesting. And so it doesn't sound like offering advisors platform, which isn't the greatest phrase, is it? But it's the best we've got for this this kind of newish model. That's not part of your.
I'm not going to rule it out. I think we're looking at a number of options for us to meet those advisor needs. So I wouldn't rule out offering advisor as a platform as one element of our offering. But But I think more generally, we could be quite creative about solving needs and problems for advisors, and we're in a number of very interesting conversations with different advisor firms. So I think it is an exciting time in that respect.
Nice one. Okay, that's great. So you raised a couple of things in there, which are going to lead beautifully onto the next things I want to ask you about, and that's about consolidation across the sector and also about ownership and the money that's fueling the consolidation. So let's do consolidation first. I think platform consolidation, you've kind of touched on, it's a scale thing, but let's talk about advisor consolidation. Nucleus in particular was classically a home for lots and lots of relatively small, very independently minded businesses. But of course, a number of those have heard the siren call of consolidators over the last few years. Have you found that your user base has been experiencing attrition as a result of all the consolidation that we read about all the time?
Okay, great question. So
thanks very much.
So look, I do believe that the platform market and the advice market are different. Mm-hmm. I think they have different characteristics. I think the platform market is quite straightforward. The economies of scale are very clear in the platform market, and I do think you see consolidation occur naturally there. I think the advice market is a harder market to consolidate. I think it's a harder market to consolidate because I think you have this very strong relationship and people element to the advice market. So I think it is harder to consolidate. I think some people argue that this time it's different because we've got a lot of private equity money going into the advice space, and we've got a regulatory burden that has increased, and so there's costs there that make more sense to spread in a larger business. Others argue that the market will consolidate and fragment at the same time because of this relationship element, and advisors will take their relationships and start up again. I think we want to be a leader in the advice space, so we want to meet needs of all advisors, and so we are there to work with the consolidators and the larger advisors, but we're also there to work with the smaller advisors and the medium-sized advisors. And you're right, the Bravura platform, the old Nucleus proposition's actually very well suited for those small and medium-sized advisors. So I think we're there for everybody. I think it's an open question how much it consolidates, mm-hmm. but we want to be there and meeting needs of all the advisors. Brilliant.
Okay, so let's talk then about the kind of rocket fuel that's getting this consolidation going, which is, it happens that a lot of it is private equity, but it is investors looking at this space and thinking, hey, I fancy a bit of that. Someone I was speaking to recently said that they thought that the smart money was in already, that the good deals had kind of been done, and what was going on now was scrabbling around a little bit, and that things weren't necessarily going to continue at the pace that they've been going at. Would you recognise that, or do you think there's lots more to go?
I think I suspect private equity is still going to be interested in this space, both the platform space and the advisor space. So I don't recognise that we've had the smart money. I think there's more private equity interest to come. I think from our perspective, private equity is absolutely the right ownership for us right now. It allows us as management to take the longer term view, to really think about building a sustainable business in the long term. We don't have those short term pressures that a public company would have, and we're able to put together businesses as we're doing, and then put together the growth through our investment in price, product and service, and private equity ownership really enables us to do that.
That's really interesting. So one of the things that advisors tell us is that they worry that PE has too short of a time horizon as an owner of a platform business, because they're writing clients onto there who may be on for 10, 20, 30 years. But it's easy to forget, I suppose, that if you're publicly quoted, your focus is quarterly.
Exactly. I don't recognise that at all in terms of private equity. So there's a couple of things I hear regularly about private equity: short-term focus and stripping out cost, and we're exactly the opposite of that. So we have a longer-term view. Our owners bought us last year. I don't know what the time frames are going to be in terms of their ownership, but it's going to be, 5+ years, I would assume. And that gives us a really good length of time to start investing and to see that investment work. And we're employing more people, we're recruiting some great people, and we're investing across the piece. So this is not a cost play, this is an investment play. But it's an investment play in the right things that create sustainable profit over the long term. And you can't do that very easily if you're in the public, short-term reporting requirements.
Okay, that's good. Now listen, we've been talking for a while, and we haven't mentioned consumer duty yet, and we get kicked out the club if we don't do it. So let's do it. But I don't think I can face talking about value for money assessments and stuff anymore. So let's talk about what you think the impacts of consumer duty might be on the sector. Do you think it's another go round and a waste of time? Do you think there's something good that will come from this? What kind of impact is it having on the shop that you run?
I think it's a really positive thing. We've put lots of work into consumer duty. Consumer duty is really all about reminding us that as an industry, we are there to create great outcomes for our customers. That's what it's about. Our purpose as an organisation is to make retirement more rewarding. We believe that's, if anything, the most important outcome for our customers. So there's lots of detail in consumer duty around fair value, around making sure our communications are clear, around our products and services. But all of it actually is pointing towards those outcomes for customers, and it's really just a reminder of that and a reminder of the importance of that. And it's so beautifully aligned with what we're trying to do as a purpose, as an organisation, that I'm really supportive, and I think it's a good thing. I think it's going to drive good outcomes. Okay, well that's good, and I know there's some cynicism out there that might not shock you that much, but it's quite nice to hear somebody being positive about it for a change. So there we go. Couple of other kind of issues that are knocking around the sector at the moment that are hot and kind of interesting. Cash rates is one. And I'm going to give Alex a break for a second, share a little bit of a pet peeve here, because a few years ago, we wrote quite a bit about cash on platforms and how it works and what the purpose of it was. And then when we had the review by the regulator, they talked a bit about cash, mainly on D2C platforms, to be fair. But nobody cared, right? Nobody did anything because interest rates were zero or very close to zero, and now they're not. I can't remember what they are today, but they might be heading north to 5.75. What's your take on this? Because Nucleus has a particular approach which some people have criticised, some people are very comfortable with. Go ahead and put your side of the story for it. Well, okay, so interest is a really, really interesting subject, and it's one very close to my heart. When we bought Nucleus, we actually inherited two completely opposite interest policies. We had James Hay, and James Hay basically didn't pay any interest to the customer, but had a lower platform fee. And we had Nucleus that paid out all the interest to customers. And we had a really good look at both of them, and we concluded that both those approaches are fundamentally wrong. We don't think either work, and let me explain why. The James Hay solution you could defend with low interest rates. It doesn't. The maths are very simple, but essentially, if interest rates are really low and you're paying out 4 or 5 basis points, a couple of percentage points off your platform fee more than compensates. So it makes sense. Much harder to justify as interest rates go up. The Nucleus approach sounds great. We pay out all the interest. It was paying out very low rates, at times 1 basis point. At 1 basis point, you know that the customer is not making any money, the platform is not making any money. Who's making the money? Well, the bankers are making the money. So it was a poorly negotiated deal. There was no real interest in the organisation that we inherited in Treasury. It hadn't been invested in. There was no need to. They were paying out all the interest. Mm-hmm. So our conclusion was actually the right way to approach interest on this transactional cash, which is about 5% of average customers' balance in their account. The right approach is to invest in a treasury function and share the interest. So give an incentive to the platform to do it properly. And I'm really pleased with the results, I think. So we now have a very professional treasury function. We screen a large number of banks, all FSS protected, all FCA regulated, and we have 9 banks on our panel at the moment to 9 set times FSCS protection. So that's a massive increase in protection for customers. We've gone from 1 basis point to, we think we'll be paying approximately 220 basis points in quarter 2, and that's continuing to increase. And we layer in our money carefully so that if interest rates do decrease, and we think they will decrease at some point in the future, there will be more protections for customers against that loss. I think the last point I would make is we're going to be middle of the pack. We're going to be middle of the pack of the platforms in terms of the interest that we're paying. That's where I want to be. I don't think it's right for us to be paying an extraordinary interest rate on what is an account, a SIP, for someone investing over the long term. Yeah? If you want to invest in the long term, invest in a fixed rate deposit account, and we will offer those alongside. So if you want to do that, you should do that. But our SIP accounts, our investment accounts, are there for the long term, making retirement more rewarding. And I think advisors will agree with me that over the long term, it's investing in the markets that give you that return. So I think there's a danger of creating the wrong incentives and the wrong outcomes by trying to replicate a very high interest paying a fixed rate account. So
I guess the challenge back to that is the one that we've read from a number of places. And Nucleus's approach is not unique, right? There are other people doing what you're doing, and lots of platforms that share interest between the company and the investor. The argument back is, look, it's just a form of investment return. How come you get some of that, but you don't get some of what I make when I'm in a fund? What makes you think it's okay to do that there?
So first of all, I think we were unique when we launched this, and what we were unique about was the transparency. So we have, we pay on what we earn, not on the base rate, because we can do better than base rate. So we pay on what we earn, and we do it quarterly in arrears because we need to understand what we've earned before we can pay it out. So I think that is unique. It's very transparent. Why is it different to investment returns? I think it's different because that money, you need to professionally manage that money. You need to invest in the ability to professionally manage that money, which is the treasury function. That's not a small undertaking. And those platforms that say they pay out all of the money, they're not managing it to the same degree that we will be with a professional treasury function. So you need an incentive to do that, and that's why we think the sharing is the right outcome.
Okay. Great, thank you, because that's a difficult one to work your way through. The second one, actually the last one for this, you'll be pleased to hear, is about price, because always that's going to come up. We've seen some quite interesting moves lately with IntelliFlow's announcement recently, and with some of the, I guess they get called neo platforms, the newer guys coming through who are pricing well below the scale players in the market. What do you think? Is that gonna drive prices down? Are we having a fresh price war here? Are you guys going to get pulled down to 15 basis points? What do you think is going to go on?
Well, price is under pressure across the industry, so I think we all feel under pressure on price, and I think we've made commitments that we are going to be driving down price. So we cut the price on Nucleus last year, and we're intending to do the same this year with a fourth tier on the Bravura platform. So we're going to be taking part in reducing our price. I think we are about offering value. So I think it is more than just price. I think it is about the service. It is about the product and the range of products that you can offer. But no question, price is important, and we need to be offering value to those customers. And again, it comes back to the outcomes for those customers at the end of the day. How do we improve those outcomes?
Okay. Right. I think we're going to let this guy go out and get a breath of fresh air now. Thanks for doing it, Alex. You've been a very good sport. Thanks for coming down to the Landcat Studios, and we'll see you next time.
Thank you.